Imagine a world where millions of dollars can vanish in a single transaction without any physical theft, hacking in the traditional sense, or even leaving a trace in the real world. This is the reality of decentralized finance, where automation and code control assets instead of banks or authorities. In February 2020, that world became painfully real when BZX, a leading DeFi lending protocol, fell victim to a flash loan exploit that drained nearly $1 million in seconds. Investors, developers, and crypto enthusiasts around the globe watched in disbelief as smart contracts, designed for efficiency, transparency, and decentralized control, were manipulated to extract massive sums almost instantaneously. The exploit sent shockwaves through the DeFi ecosystem, exposing critical vulnerabilities not only in lending protocols, but also in oracle systems, cross-chain interactions, and smart contract design. Flash loans, which were meant to provide liquidity and arbitrage opportunities, had been weaponized against the very platforms that enabled them. The incident highlighted the fragility of DeFi platforms, the need for rigorous auditing, and the unforgiving nature of blockchain technology. BZX protocol, lending, leverage, and DeFi innovation. BZX was designed as a decentralized platform for lending, borrowing, and margin trading, enabling users to participate in financial markets without relying on traditional intermediaries such as banks or brokers. By leveraging smart contracts, BZX automated loan execution, collateral management, and margin trading in a seamless, trustless environment. Its promise of automation, transparency, and efficiency quickly attracted thousands of users seeking to maximize returns in the rapidly growing DeFi sector. However, this automation, one of the platform's greatest strengths, also introduced hidden risks. BZX relied heavily on price oracles, external data feeds that determine the value of assets, to manage collateral and loans. Even slight inaccuracies or manipulations of these oracles could lead to catastrophic outcomes, a fact that would be brutally demonstrated in the flash loan exploit. While flash loans were designed to be powerful tools for arbitrage and liquidity provision, in the wrong hands they could become instruments of financial destruction. Understanding flash loans, a high-risk mechanism. To fully comprehend the BZX exploit, it is essential to understand flash loans. Unlike traditional loans that require collateral, flash loans allow users to borrow any amount of cryptocurrency instantly, with the condition that the loan is repaid within the same blockchain transaction. These loans are executed automatically by smart contracts and do not involve human intermediaries. They are designed for arbitrage and liquidity, enabling users to take advantage of price differences across exchanges. However, flash loans are also inherently risky because they amplify both the opportunities and vulnerabilities of the protocols they interact with. In BZX's case, the attacker borrowed a significant amount through a flash loan and manipulated token prices via decentralized exchanges. By exploiting weaknesses in the oracle system, they temporarily inflated the value of certain tokens, creating an artificial imbalance in collateral requirements. This allowed the attacker to borrow against overvalued positions, instantly repay the loan, and pocket the difference, all executed automatically in a single transaction. The speed, automation, and immutable nature of blockchain meant that there was no human intervention possible, leaving investors powerless to prevent the theft. The exploit, how millions were drained. On February 14, 2020, the attacker executed a carefully orchestrated sequence of operations using a flash loan. They borrowed a large sum of crypto, manipulated token prices on connected decentralized exchanges, and then tricked BZX's smart contracts into approving inflated loans based on those manipulated prices. Within seconds, nearly $1 million in Ethereum, wrapped tokens, and stablecoins were transferred out of the protocol and into the attacker's wallet. No hacker needed to physically break into a system. The exploit relied entirely on the inherent logic of DeFi protocols, smart contract code, and oracle vulnerabilities. This attack highlighted the complex interactions between different components of the DeFi ecosystem, showing how even small errors in design could have catastrophic effects. It also underscored the inherent risks in relying on decentralized systems. While removing intermediaries reduces some risks, it introduces new ones that require advanced understanding and vigilance. The BZ's exploit became a chilling reminder that trust in code and automation is not always enough. Human oversight, audits, and redundancy are still critical to safeguard digital assets. Market and human impact. The exploit immediately shook confidence in BZX and reverberated throughout the broader DeFi market. Investors panicked as token prices fluctuated, and other lending protocols began scrutinizing their own systems for vulnerabilities. Users who had trusted BZX with their assets faced anxiety, frustration, and disbelief, highlighting the human cost of blockchain exploits. Crypto communities erupted with discussions on social media platforms, forums, and developer channels, offering explanations, theories, and sometimes misinformation. Developers scrambled to patch vulnerabilities and reassure the community, while regulators, security firms, and exchanges observed the incident with renewed urgency. The exploit demonstrated that even sophisticated automated protocols are not immune to human error, oversights, or exploitation. It also reinforced the importance of risk management and informed participation in decentralized finance. The speed and scale of the attack made it clear that in DeFi, technological efficiency and human trust are precariously balanced, and the smallest flaw can have enormous consequences. Blockchain black holes. The bigger picture. BZX is a textbook example of a blockchain black hole, where digital assets disappear due to vulnerabilities, design flaws, or exploitation of smart contract mechanics. History is filled with similar cases, from the DAO hack to Parity Wallet and Poly network exploits, all demonstrating the unforgiving nature of blockchain technology. Each incident emphasizes the duality of decentralized finance. It offers unprecedented opportunities, but also exposes participants to irreversible risks. Millions of dollars can vanish in minutes, leaving victims powerless to reverse transactions. Users must understand that decentralization, while eliminating certain intermediaries, introduces new risks that demand knowledge, caution, and constant vigilance. Protecting private keys, diversifying holdings, auditing smart contracts, and staying informed about potential vulnerabilities are essential strategies in today's DeFi ecosystem. The BZX flash loan exploit will forever serve as a cautionary tale in the history of DeFi. Millions of dollars vanished in seconds, demonstrating that even sophisticated smart contracts and decentralized systems are not immune to catastrophic failure. To protect your assets, always use multiple secure wallets, stay updated on smart contract audits and platform security reports, understand the risks of flash loans, and never rely solely on platform promises. Engage actively with the DeFi community, remain informed about vulnerabilities, and adopt defensive strategies to minimize exposure. If this story shocked you, like this video, subscribe, and hit the notification bell. Share your thoughts in the comments. How would you react if your crypto were drained in a single transaction? This is Blockchain Black Holes, uncovering the hidden dangers of digital money that no hacker needed to steal, but that design flaws, oracle manipulation, and code vulnerabilities made possible. Remember, in crypto, knowledge, vigilance, and preparation are your only shields against disaster.